Test, test, 1, 2, 3. Test, test, 1, 2, 3. All right, what's going on, guys? Going live for the Fed meeting today. We are expecting a 0.75% interest rate hike. We have Jerome Powell speaking in about 30 minutes. So make sure that you guys are aware of that. The 0.75% looks like it's already getting factored into the overall market. I'm going to start sharing my screen so you guys can see exactly what it is that I'm looking at. It is 11:01 a.m., which means that it is 2:01, obviously. Let me go ahead and move this thing on over to this side. But overall, TQQQ has been pretty bullish for most of the day. Now it's just really to see how the market's been reacting. I don't know if you guys would agree, but there it goes. We have TQQQ beginning to rise right now. Let me know what you guys think about the stream quality. The stream quality should be a little bit better, especially in comparison to what it was last time. So I hope that you guys enjoy that one. What's going on? What's going on? Ricky the man. What's going on, guys? Well, I appreciate you guys asking for me to go live. Very happy to be here. And it should be fun to see Jerome Powell speak. So we're just going to be waiting out on that. What's up? What's up? Yep, 0.75% was just announced. Those were in the Fed minutes for the FOMC meeting. And then it should be Jerome Powell that's going to be speaking for just a very short period of time. Here it goes. I'm going to be pulling this thing up. All right. It's not looking the best, but it's not looking the worst for TQQQ based off of how it's trading right now. I'm downloading the PDF. Give me one quick second. Here it goes. All right, this is what we got going on right now. Oh, blah, blah, blah. With unemployment, yep. Appropriate monetary policy. Here we go. Real GDP. To my understanding, with this 0.75% rate increase, we have not done this in the past 30 years, or I think nearly 30 years. I think it's 1994 the last time. And again, please fact check me if I'm wrong. Give me one quick second. There it goes. Market is dipping 2.6%. TQQQ dropping. When TQQQ drops, that means that the NASDAQ market is dropping, which means that most of our tech stocks are most likely taking a plunge. But let's be honest, with what happened on Friday and on Thursday, Friday and on Monday, I don't think I'm very surprised with that at all. So yeah, quickly dropping right on over here. This is something that we've been talking about for quite some time. I uploaded a video literally right before this, making you guys aware of the meeting, making sure that I reminded you that as we're approaching previous highs for the NASDAQ market, that I wanted you guys to be at least aware, just in case that the market did drop. I wanted you to kind of be aware an hour and a half ahead of time. So if you wanted to reduce your position size, or if you wanted to buy more, right, you can do whatever it is that you want. So Jerome Powell is going to be speaking in about 25 minutes. And he's also going to be speaking in tomorrow morning as well. So I'm long on SQQQ at 59.01. Well, SQQQ has been performing pretty well, right? So not too surprised with that one. Yeah, TQQ dropping as of right now. I don't think this 0.75% is catching many people off, guard at all by any means. So yeah, let it bleed. This is what we're anticipating, and if anything, right, instead of trying to predict the bottom by allowing it to bleed, that just means that we get to have it at a lower price point. So I just locked in some profits, Flame Boy. I like that. Looks like we might be going into the red for TQQQ. I'm trying to read these different things. How much lower do you think that this will go? Again, I'm not here to predict the future, right? Just here to prepare for it. So regardless of how low it goes, if you keep a healthy position size, meaning not so much, but also not so little, it doesn't matter how low it goes, right? We all know that after a period of time, markets do end up recovering. So let's just be aware of that. Alright. Yep, live stream will begin in 20 minutes. I hope that you guys are aware of this. There is no live stream until Jerome Powell speaks, and that's in 20 minutes from now. So please be aware of that. So I just bought some SQQQ now, doing very well. Thanks, Ricky, for the channel. All of you has changed me loads. Happy to hear that. So here we go. Yep. All right, 3 minutes ago, updated just so you guys can see why the market's reacting. So we got Feds raised by 0.75%. Again, not much of a surprise. Largest increase since 1994, so we were correct on that. Inflation is running at a 40-year high since 1987, if I'm not mistaken. And officials have agreed to a 0.75% point increase in the two-day policy meeting, including Wednesday, which will increase Fed's benchmark federal funds from 1.5 and 1.75%. So again, I think just because of how bad the CPI data is, and I don't know if you guys would agree, right? 0.75%, this was factored into the market already. I personally do not think that this is bad. This is why on Monday we sold off. On Friday we sold off when that CPI data came out. It showcased that inflation did not peak. That was bad. We live streamed that as well. With what's going on right now, I mean, the market already sold off so much on Monday that now it's like, yeah, I mean, we did pull back a little bit, and rightfully so, right? It's still, the market still needs to react in some form. It actually would not surprise me if we actually end up making new highs and actually begin trading above $25 a share for something like TQQQ. It's not worse than expected. And this is one thing that you'll come to understand when it comes down to the overall market, is that things get factored in right away. When it comes down to real estate, when it comes down to other markets, it takes time for them to get factored in, not for the stock market. There's an instant reaction, and if anything, sometimes there tends to be an overreaction. So please be aware of that. No, when people are asking me to buy now, it's not about that, right? This is only part of it, right? You guys, if you guys paid attention to my previous video, what you guys must have heard me talk about is that them releasing the interest rate hike is one thing. The guidance and expectations for the up and coming future is something completely different. So there's going to be a live stream in about 20 minutes. And that's where Jerome Powell, who's the head of the Federal Reserve, is going to be speaking on what their guidance is. This is like when a company reports earnings, it reacts, we reacted, and then it's when the actual executives speak and they give their guidance. That is where I think most people are still scratching their head. They don't know if the Feds are going to take an even more aggressive, or if a 1% rate increase is on the table, because that was considered off the table right? The biggest increase that they expected as of 2 meetings ago was a 0.5%, right? But now we're at 0.75%. So now asking the question, would we consider a 1% rate increase? All right. So where is the guy that asked for the FBI instead of the Fed? Hey, don't call my boy out, right? In my previous video, I don't know if you guys watched it, but in my previous video, I mean, I get a bunch of, you got to admit, right? There's a lot of people that are just getting started in the stock market. And trust me, I've made more silly mistakes than just that. Just a little heads up right now, TQQQ is showing signs of a support, and we're still waiting for the Fed meeting to begin in about 18 minutes. We will be live streaming it, and I'll be showing the video here. So just make sure that you're aware of that. But we had someone comment in my previous video, like, I kept talking about the Feds because that's what they're referred to, right? The Federal Reserve. They're the ones that raise interest rates. They just announce what they announce, right? This person asked, what does the FBI, when I refer to them as the Feds, have to do with raising interest rates? And it's a, it's a an honest mistake from someone that's just getting started, right? Alrighty. Do you guys have any questions? We're up 3% on the day. It's like I saw a lot of people get very excited. Unless you're day trading TQQQ, and even day trading, I mean, we're literally at that break-even period. If you guys look at where TQQQ opened on the day, we're literally right there, right? So you guys can see where it opened at. We're opening at 24.07. We're actually a little shy of 24.07. Right now we're at 23.95. Looks like it's trying to set up for a potential reversal. MACD's looking good. RSI's looking good. Let's see if we can get enough buying pressure again. Indicators are to only be used as a reference, never as an actual reason on why to take a trade, right? I like to use them as a confirmation of like, hey, is the price action, is it actually indicating signs of an uptrend? Something that we can follow up with. But all right, 15 minutes, a little bit over 15 minutes before the live stream begins. Here it goes, a pretty nice setup for a day trade on TQQQ. What is this? A 4% setup. Dude, I'm like choking on this. I haven't had lunch yet, so I had my little like meal prep thing. Please excuse me if you guys don't want to hear me eat. I'm a light eater anyway, so it's fine. It's just chicken and mashed potatoes. So I have a full position on TQQQ. This is why we talk about position size. I mean, I can't stress this enough, right? We try to preach it, and I don't know what other YouTubers do. I mean, I really don't watch other people. But one of the things that I hope that you guys understand from our channel is we always try to take the downside risk into consideration. I feel like every other YouTuber, and rightfully so, they do a great job making you aware of what stocks have potential. Great. But let's be honest, stocks going up, that's only part of trading. That's only part of investing. What about protecting your downside? If anything, in my opinion, that's even more important, right? Which is why we try to preach why it's so important to manage your position size. It's not about averaging down, right? And making sure that you put yourself in a position that you can tolerate. Literally the video that I uploaded right before this, I didn't need to upload a video. And people get upset like, Ricky, why are you uploading a video an hour beforehand if you're not gonna live stream in that video? And it's like, I want to give the beginner trader and beginner investor a chance and a heads up of what's about to happen. Because I know that that's what I would have appreciated before I got started trading. I don't know about you guys. I hope that you guys do appreciate it. I hope that you guys know that I always try to look out for your downside and taking risk into consideration, because that's a huge part of trading. And I really hope that you understand that. Yeah, I don't know what's going on. I think I can ban them. If you guys continue to spam, we're gonna have our guys block you. Live stream starts in a little bit over 13 minutes. Please make sure that you're aware of that. If you guys have any questions that you guys would like to ask me, feel free to ask it in the chat, but please be respectful to other people. Yep, the Feds did announce it's a point. I don't know if I should like have it in this just so when people are coming on in, they can see it. So maybe I will for at least a little bit. I just don't want to keep answering. I still think that we'll be getting the question. All right, let's see if I can put it here. There it goes. Super nice reversal on TQQQ. There it goes. The Feds announced just a couple minutes ago, so I hope that you guys can see this. Feds announced a interest rate hike of 0.7%. I'm going to have that over here just so all the people that keep asking, you guys could clearly see it for your sake. All right. So need this relief rally for sure. Yeah, I mean, I guess it is a little relief. Oh shoot, I guess it is a little relief rally, right? I mean, markets on Monday sold off nearly 14%, them being up 5%. It's like, it's kind of like that meme. Have you guys seen where like it's like a chart of something selling off like 20-30% and then something going up like 2 or 3%, and then like hooray. I feel like this is with the markets barely going up, but yeah, a lot of us or a lot of people get very excited. And yeah, I'm very grateful that today is not a red day, especially leading to it being so important. So I 100% agree with that. Let's see how many people we have in here. All right, looks like we have 273 likes, but yet we have over 3,000 people. Guys, I'm kind of offended. What? I thought we would do better than that. So 0.75% isn't going to do and stop inflation. It's just to push us deeper into inflation. Some people are just a little bit too much for me. Do you guys want me to? I mean, I've shared my opinions many time before when it comes down to the CPI data. So I think when that CPI data came out on Friday, it was made very clear that the interest rate hikes that they were doing or showing or putting into effect were not doing much. I agree with you. But my biggest concern is if you actually look at that CPI data, a majority of what's gone up is oil and what trickles down to other areas as in retail and transportation services that is influenced by oil prices. My concern is you can try to increase interest rates as much as you want, but if you do not fix our supply issue for oil, how will we actually see a decrease or a peak in our inflation if oil has the biggest influence on that data? It's one of the biggest factors of month over month that is seeing the biggest increase. That is my biggest concern. The Feds can't do anything when it comes down to that. It has to be our person in power that has to take accountability and put things into effect, regardless of what it is. Regardless if you agree. I saw a couple of the other comments when it came down to like, I guess it's just dependent on what you see to be more sustainable, right? Where they were saying like, no, like he's pushing us towards a cleaner future with EV vehicles. Who is like the leader in EV? I feel like it's pretty safe to say, regardless if you like him or not, it's Elon Musk, right? And even Elon has openly said that although EV is something that we should definitely work towards, this is not a sustainable nor possible, like we need a solution for oil right now. And even someone that is so pro EV, for them to openly speak out about that, I think just speaks volumes. Let's hit 1,000 likes. Yeah, let's see what we're at. 856 likes. I appreciate you guys. Thank you guys for tuning on in. I really do appreciate it. Make sure that you guys subscribe to the channel. Our team got upset. No, they didn't get upset, but we did a giveaway on the last live stream. Maybe we'll do a giveaway today. Maybe we'll do a giveaway right before the actual Jerome Powell live stream. So hit that like button. I don't know how many likes we need to hit. What do you guys think? 50% of you guys should hit 1,500 likes. All right. Those giveaways are fun. Yeah, it seems like a lot of you guys enjoy them. There's a comment right now in the chat that's saying Elon doesn't make money from selling cars, it's government subsidies. Although I do agree that, do I believe that Tesla would have been possible without government subsidies? Probably not, right? I do agree that, I mean, it's an incentive that was made available for EV vehicles. There's a lot of subsidies for a bunch of different areas. There's a lot of other EV vehicles that were offered the same subsidies. Yet Tesla was the one that came out on top. So for you to discredit all of their success and attribute it only because of those subsidies, I think just speaks a lot, or maybe says a lot about yourself. And that's just the thing. It's just like there's people like you that will blame and or try to bring down people for no apparent reason, right? It's like, I get it. Tesla, and it probably would not have been as easily attainable, nor would it be where it is today if it wasn't for those government subsidies, right? But to my understanding, right, it wasn't just Tesla that were offered these subsidies. If something is offered and someone takes advantage of it, right, rightfully so. They're put in place for a reason. And that's the part that I just do not, it's not, I mean, that's not how all of their money is made, right? They're on track to sell more Model Ys this year than any other automaker. Is that all because of subsidies? It's like, yeah, everyone starts somewhere, and a lot of these companies, right, especially when they're put up against GM and Ford and all of the big, automakers, they have a lot playing against them. So they created government programs such as these subsidies that gave out grants and loans. And guess what? I mean, he became the richest man in the world. Not bad. Yeah, I just don't understand why discredit someone's success. It's like, you try to do it then. Fisker tried to do it. Where are they at? Right? It's mind-boggling to me how people are so opinionated about something that they have, really no ground to speak on. I just don't necessarily get it. All right. So we have about 6 minutes, a little bit under 6 minutes before they go live. Broke people find it entertaining to discredit others because they have no imagination. I wouldn't put it like that. I just think it's like, it's always the most opinionated people that most often have the least ground to, speak on that subject. And or they use one little piece of, they were based off of subsidies, and it did play a huge incentive. It's great to speak on it, right? But to attribute all of their success solely based off of that, no, there's a lot of government subsidies for a lot of different companies that never end up getting relatively close to the success that Tesla nor Elon have experienced. So if you're going to use one thing as an example, use it for everything else in scale as well. It's jealousy. It often is. Yep. All right, there we go. 1,100 likes. I appreciate you guys. Let's go ahead and get this ready for Jerome Powell. He's going to be speaking in just a couple of minutes. Again, make sure, just in case it gets disconnected, to in about 3 minutes, they will be hosting this live stream. I like that. They will be hosting the live stream for Jerome Powell to be speaking. So make sure, in case this video gets disconnected, that you guys subscribe to the channel and turn on your post notifications. All right, let's see if we can pull it up. Here we go. All right. This one's going to be fun. I really do appreciate, I mean, there's a lot of different things that you guys could be doing right now, right? But you guys are choosing to tune on into a live stream having to do with the overall stock market, and it just shows how eager it is that you are to learn more and do better. And I think that says a lot, regardless if you guys follow me or not or subscribe to me. Who cares, right? In the grand scheme of things, I'm happy to see that there's so many of you guys across the world that are so passionate about investing. So kudos to you. All right, setting it up. We got a little bit under 3 minutes. Let's go ahead and set up this live stream again. Make sure you guys drop a thumbs up if it's not too much to ask. Alrighty, pulling it up right here. We got it. We got it. Okay, I'm gonna turn this off. Again, one of the big things for those that are just starting to tune on in, I want to make sure that you guys have access to this. The Fed's just announced a 0.75% increase. This was factored into the market already, so we're not very surprised about it. What now we are waiting to see is Jerome Powell is going to be speaking. For those that don't know who Jerome Powell is, he is the head of the Federal Reserve. He's going to be giving his guidance and expectation of what they intend to do in the up and coming future. This is probably one of the most important parts of this Fed meeting. What they release were the Fed minutes. This is when they meet up and they break down, as a party of what they're okay with, raising interest rate at. Now it's more about the guidance for the up and coming future and for future interest rate hikes. What is off the table? What is on the table? And again, then the market reacts based off of what is said. So
a monster was attacking, but the team remained.
All right. Looks like we are starting pretty soon. All right, let's go ahead and add this to it. Okay. Can you guys see the live chat on the right-hand side? You guys should be able to see it, right? And just a little heads up for those that care. I'm sorry, I actually said it was tomorrow, but it's not tomorrow. It's going to actually be on Friday. Jerome Powell is going to be speaking at 8:45 a.m. This is about 45 minutes before the market opens. So please make sure that you're aware of that. This is Friday, June 17th. June 17th. Here it goes. All right, I'm going to shut up so you guys can hear him. All right, can you guys see it okay? I'm going to put myself in the little corner. All right, let's see which way the markets go. Looks like they're waiting for him to walk out. Here it goes. Big JP. All right. Oh.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates.
Markets dropping.
The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate.
0.75%.
And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy.
Yep.
Coming out of our last meeting in May, there was a broad sense on the committee that a half percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting.
Oh, okay.
This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy.
Check it
Clearly,
out.
today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common.
That's good.
From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
Okay.
We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our
Look at that.
overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires
Check it
a
out.
recognition that the economy often evolves in unexpected ways.
There we go.
Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
Watch out for that resistance at
We
$25
therefore
for
need to be nimble in
TQQQ.
responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, let's see what these questions.
Thank you. Howard Schneider with Reuters. Two related questions, Chair Powell. Did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent.
Check this out.
And so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations.
8% on the day,
that,
hitting 9%.
If
We are
the
overbought
economy
on the
performed-
day.
If data came in worse than expected, then we would consider moving even more aggressively. So we
Oh, that's not that good.
got the CPI data
Yeah.
and also some data on inflation expectations late last week. And we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead. And so we did.
I think that's good.
And
They're proactive about it.
That's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilek with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range, in that more normal range, and that's a desirable place to be because you begin to have more optionality there.
Correct.
About the speed with which you would proceed.
Check that out.
Forward.
Almost 10% on the day.
Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year, and that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent.
Check
Then
it out.
You're looking at next year, and what you're seeing is
10%
people
on the
seeing
day.
more,
TQQQ.
a bit more tightening in a range of 3.5% to 4%, and that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seemed like the right thing to do at this meeting, and that's what we did.
Nice.
Steve?
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, Could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So
a quick little heads up. This is for our traders, not for our long-term investors. I'm choosing to hold. Again, my main focus every single time is making you guys aware when things are overbought. TQQQ is up nearly 10% on the day. It looks like that's going to be the resistance level for the day. Most often, any reaction tends to be an overreaction in the market intraday. So if your intention was to day trade, then please be aware of that and what is going on right now. It is very, very overbought. By TQQQ being at 10% on the day, that means that the NASDAQ is at over 3.3%. The amount of days that it's closed over 3% into the 4% in the green have been very, very slim, meaning that it could potentially pull on back. I'm making you guys aware of this, as I would hate for you guys to give back all your profits if that was not your intention. If you want to hold. But if you want to lock in profits and that was your intention, I just want to make sure that if you're a beginner trader, that you are aware of that. Sorry for interrupting. Just wanted you guys to be aware.
We can affect with our policy tools. There are many things we can't affect. And those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But does 3.8%, 4% get it done? Does it get the job done and breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're gonna find that out empirically. We're not going to be completely model driven about this. We're gonna be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
I like that.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures,
higher
most
lows
of the time, that's what you see.
That's a good sign.
If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
That was a weird answer.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
I'm going to quickly wrap up. If you guys want to continue to watch it, again, you guys can go to the Federal Reserve YouTube channel. But one of the things that I quickly want to wrap up, my computer's already overheating, is why did the market push up? This is a question that I see a lot of you guys are asking right now. The biggest thing is that the market sold off on Friday and the market sold off on Monday. The Monday's reaction was that because of the CPI data that came out on Friday, it was made very clear that the 0.5% increase that the Fed was previously taking into consideration was not expected. I actually think that if the Fed only raised interest rates 0.5%, that it probably would have caused the market to sell off more, because they're taking on the challenges that the stock market has to, or not stock market, but that inflation has to offer, not head on. And you guys heard him say this himself, where it is so important for them because of where inflation is. Inflation is at 40-year highs. With that being said, by raising interest rates 0.75% and approaching it head on, sure, they could have raised it maybe 1% if needed, right? But at least by trying to be more aggressive up front, and if they see it actually doing better, then they at least then have more to work with, rather than taking a more or a less aggressive approach of staying at the 0.5% and then seeing later on of, oh yeah, now we're really going to have to increase it from 0.5% and maybe 1%. So there's no right or wrong, and I can see that there's going to be a lot of people that are going to be agreeing to disagreeing, and rightfully so. That is your opinion, and that is your right as an American. I'm not here to convince you. I'm just, there's only specific tools that the Federal Reserve really have in effort to try to fight inflation. And at least to myself, right, to me, it sounds like they are trying to be proactive in the tools that they use and how aggressive they approach it, because they are taking it seriously. So why is the market reacting? I think the market is respecting how aggressive the Feds are choosing to take on and really fight back inflation. That is my take at it, and you guys can share your comments down in the comment section. But other than that, I still personally think that because of that CPI data, I still think that oil needs to be a really big focus, and this has nothing to do with the Federal Reserve. The Federal Reserve cannot make a policy on oil itself. So therefore, I think that's where our president needs to come in, and or Congress, and come up with a policy and or a solution for our supply issue. If everything in our CPI data is being negatively influenced because of the price of oil, then why is all the blame being put on the Feds when the Feds cannot make up any form of policy to aid oil and the supply issue that we currently are experiencing? I'll leave you guys with that. But I really do appreciate your guys' time. Friendly reminder, I live stream every single day. I upload new videos on YouTube every single day. If you guys are new to the YouTube channel, I would love to answer your questions. I hope that you guys know that I answer all questions on Discord or on Instagram. The first link down below is for my free Discord. Please, even if you're an absolute beginner, even if you've never invested or traded before, even if you've been thinking about just getting into it, message me. Just let's spark the conversation. All my links are down in the description. And also, friendly reminder, I do trade live every single day. So if you've ever wanted to see what it's like to watch someone buy and sell and trade in the stock market, share their thought process, especially with markets being so choppy, if you think having someone every morning right at market open to be of value for you, I encourage you, take 2 minutes, click that second link down in the description and learn a little bit more about our Learn Plan Profit group. I really do appreciate you guys' time. I hope that we earned your thumbs up. I think based off of what was expected of this Fed meeting, seeing how it reacted is a step in the right direction. But friendly reminder, the last thing that it looks like my camera already turned off. My camera was overheating like I told you guys, so I do apologize for that. But the last thing that I do want to share with you guys is how important it is right now during uncertain times to take your position size into consideration. This happened shortly after the previous Fed meeting where they increased interest rates 0.5%. The initial reaction was positive, and then the day after, it was actually the next trading day, it was bearish. So what I want to remind you is just based off of my experience and what I've seen happen before, reducing position size and or staying light with your position, it's never a bad idea, especially when markets are super, super bearish. Again, just making sure that we take downside risk into consideration. I really do appreciate you guys' time. I hope that, I earned your thumbs up in this video. Please do not forget to subscribe. I upload new videos every single day. And like always, let's make sure that we end the year on a green note. Take it easy, team.